Pepsi is down 3% after reporting its earnings. It also announced a nice dividend increase. Is it an undervalued buy now to add to our portfolio? Let's take a look in today's episode. As always, we'll run through the historical performance of the stock. We'll look to their revenue year on year, top line, as well as their bottom line net income. We'll look at the health of the company, total cash versus total debt. We'll see how well they've performed in the industry as well as the last 5 years. We'll also talk about institutions, what they've been doing quarter to quarter with this company. We'll look to some insider selling that we note with the vice chairman, give our thoughts. And importantly, we will look at their earnings to see where exactly they have gone wrong for this drop in the share price. And importantly, we'll talk about the dividend safety, look at their financial metrics, talk about the free cash flow, which we have flagged episode to episode, and we'll run them in through the stock valuation model, getting to our intrinsic value, talk about our margin of safety and our acceptable buy price, and as always, we'll look to Wall Street to see what they forecast for PepsiCo over the next 12 months. So let's quickly talk about the historical performance. Now, they are down 3% after reporting their earnings. They have come down as much as 4%. Over the last year, however, they are down 1%. Bear in mind, it doesn't include those dividends reinvested. Over the last 10 years, looking quite nice, in the right direction, the right trend, up 117%, although we do note their all-time highs in May 2023 at just under $200. They are in the mid to lower end of the 52-week range with a yield just under 3% and a forward P of 23. So before we get into the details, let's have a look at their earnings. Now, the headline reads that PepsiCo earnings top estimates, but their quarterly revenue slides. Now, this is the first time in nearly 4 years, so very unfortunate. Now, we'll look at the numbers, but we do note here that their net sales fell 0.5% in the fourth quarter, which isn't great. But the reason for this is attributed to the high borrowing costs as well as low personal savings that have squeezed consumer budgets. And now we talk about this consistently on the channel with the consumers being essentially squeezed with their budgets. This does affect a lot of things, especially the margins of these big companies. Now, in terms of the numbers, earnings per share, it was a beat, $1.78 adjusted versus 1.72, which is positive to see. But we do note their revenue did come in just under at $27.85 billion versus Wall Street expectations of 28.4. And as we mentioned, this is the first time they did miss this nearly for 4 years. When we take a quick look at the forward guidance, what we can see is that management expects in 2024 that their organic revenue will rise at least 4% and their core constant currency EPS will climb around 8%, which is fairly positive to see, although we do note that the increase in organic revenue was expected to be around 4 to 6%. So that's the numbers that we have taken a look at in terms of their revenue. Now, remember, on the top line, what we're looking for here is 3 to 7% growth year on year. 65 billion reported in 2018, 86 billion in 2022, 92 in 2023. So we can see in actual fact their top line has increased, which is positive to note. And what I like about this are those increases year on year that we do see with PepsiCo. Every single year their top line has been moving in the right direction. Now, we will look at the last 10 years percentage wise too as well. Bottom line, the story a little bit different. 12.5 billion reported net income in 2018, 8.9 billion in 2022, 8.3 billion in 2023. So what we're seeing here is a drop in their bottom line over the last 5 to 6 years. In fact, it did go down all the way to 2020 before increasing up to 2022, and then we are expecting a decrease. So while their top line is increasing quite nicely year on year, the bottom line shows not a great story, and we'll look at some metrics shortly as well to divulge in that. Now, quick health check, 9 billion cash and short-term investments in 2018, 10.3 billion in their latest quarterly report. So they do hold a fair amount of cash. It is also an increase from the last 5 years as well. Now, bottom line, or in fact total debt numerically and directionally, what we can see, it has increased from 32 billion to 45 billion. Now, it's not great to note that their total debt has been increasing, but it is something, again, we will look at when we want to see the net debt to EBITDA metric as well as the dividend safety. Now, over the last year, when we compare it to other companies in the soft drink and non-alcoholic beverage companies, Coca-Cola, Monster Beverage, Dr. Pepper, a few others, we can see that PepsiCo, including dividends reinvested, is one of the worst performing, just up 1.56%. Again, we can see though one rival competitor, Coca-Cola, up marginally more at 2.36. Now, when we expand this to the last 5 years, what we see is that PepsiCo is up 72%. Not too bad, significantly higher than Coca-Cola, but again, it isn't the greatest return over the last 5 years. Nonetheless, it is important to note that the highest in the industry we can see here is Monster Energy, and that was 91.5%. And it's also key to remember that past performance isn't an indicator of future performance. Now, institutional ownership sits at 71%, 28 billion worth of sales by these institutions over the last 12 months. Over the same period, a lot more buying. Institutions are buying a significant amount of PepsiCo. The largest buy came in Q2 of 2023. In Q3, what we see is a little bit more selling than buying. However, in the most recent quarter, Q4, a lot more buying, 5.6 billion versus 1.2. So again, institutions do quite like this company, but as always, do your own due diligence. Never go off what the institutions do. Now, over the last 3 months, we ran PepsiCo through the insider selling and buying screener. We only get one insider sell by the vice chairman and CFO, Hugh Johnston. Now, he has sold around 48,000 worth of shares, as we can see here. The price, $166, as we can see, not too far off the current trading price, and he sold around $8 million worth. Remember, insider selling isn't necessarily a bearish signal. They do sell for many reasons, whether that's personal or financial. And that does bring us to our latest free weekly newsletter, where we do discuss insider buying and selling, different trends, as well as running through some companies that have been buying heavily. Also, you have access to other free weekly newsletters where we run through undervalued companies, as well as our screener for identifying companies that are trading at a low price. Moving on to the dividend safety, we have a score of 93, very safe. Market cap, 242 billion. It is a mega cap company. Now, in terms of those recessionary metrics, well, they increased the dividend during the last recession. They had above average growth, negative 0.5% versus the S&P's negative 12, and they also outperformed the S&P 500, negative 35 versus the S&P's negative 55. 7.1% increase today, so very nice for shareholders. Pretty consistent with the increase over the last 5 years. Over the last 20 years, though, we do see some nice double-digit growth. What's also very nice to see, they are a dividend king. They have been increasing those dividends for the last 50 years. Now, in terms of dividend yield theory, as always, it states a company is undervalued when the current yield sits above the 5-year average. We have that sign of undervaluation, 3.21 versus 2.83, although do bear in mind we don't look at any of these models in isolation. 21.1 on the forward PE, again lower than the 5-year average, another sign of undervaluation, although we do note the consumer staples sector PE does sit slightly lower at 19.1. One of the issues that I have had with PepsiCo, if you are a regular viewer, you understand, it is the free cash flow payout. Now, very quickly, we do tend to ignore the earnings. It is susceptible to manipulation by management through accounting. We can run through one example now as well. And this is because if we looked at 2022, on the earnings 67%, you'd be happy. You might be looking at below 70%. It meets your target. When we look at the free cash flow, 111%, what this signals is that in 2022, management paid out more in dividends than they generated in free cash flow. Big red flag indicator. And over the last few years, we see it is pretty high, above the 70%, although for me personally, I look at 60% or less. That gives me faith that management are able to offer double-digit increases. 2023, 96% is what they're expecting. That is very, very high. That is a big red flag indicator for me. The only thing that makes me a bit happy is to see it come down in 2024, expected 75%, which is okay, not the greatest, but it will be the lowest rate since 2017. Just something to flag there. Free cash flow per share has pretty much decreased over the last 10 years, 447 to 406, although we do note a lot of inconsistencies, a lot of volatility. 2023 at 505, 2024 expected 671, does look positive, but just bear in mind the type of companies you're investing in. PepsiCo isn't a fast-growing company, it isn't a technological company, so just have realistic expectations. Top line, what we like to see, steady moderate growth, 3 to 7%. The last few years it has been increasing, that is nice to see. 2022 at 9%, 2023 10%. It is nice to see those double digits to PepsiCo's top line. Now, numerically, what we can see, 66 billion to 92 billion. So they have increased their top line by around 50% over the last 11 years. What they also do, although not consistently and not a massive amount, they do share buybacks, returning excess cash to investor pockets. 1.56 billion in 2013, 1.38 from the latest quarter. ROIC, this is what I love to see. Not only is it above the minimum 10% that I look for, as that gives me faith management are able to effectively allocate their capital, the consistency pretty high in the teens year on year. 2023 at 20%, looking very nice to see. No worries for me in terms of management when looking at that part of my investment thesis. Operating margin above the 16% is really what we want to see for consumer staples. It is pretty inconsistent. I mean, it is around the 16%. The only thing I would say here is, as I mentioned earlier at the beginning of the video, it is an issue we are facing with consumers being squeezed. The way that companies like PepsiCo will be enticing customers to come and buy their products will be to reduce their margins, reduce their prices. But you also have to bear in mind the issue with inflation. So PepsiCo, on one hand, need to increase their prices just to keep up with that high inflation rate. On the other hand, they will be thinking they need to also entice customers to buy their products. So that is a bit of a battle. So we do see this around 14% in 22, 15 in 2023. Free cash flow margin, it is above the 7%, but again, it has been decreasing over the last few years, something just to keep an eye on, but no massive red flag indicators so far. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization will show us the dividend safety as well as the balance sheet strength. Well below the maximum 4 that we look for. 2023 at 1.95, showing us the number of years it would take the company to pay all of their debt net of cash on hand. 2024 expected to go lower. Again, no real worries. They are bringing down that debt amount. It does look positive. Dividend does look safe. So let's jump into the valuation. As always, if you're enjoying the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, Graham's valuation formula, we're not including it in today's episode of Pepsi. They have been increasing their top line double digits over the last few years, so we will move on to the multiples valuation model. We have the P multiples of those companies we analysed over the last 5 years. We have their average P multiplied by that of Pepsi to get an intrinsic value pretty much around the current value, a few cents shy. So whilst it says overvaluation, in reality, it looks to be around that intrinsic value. We then move on to the dividend discount model. Very strong growth over the last few years, around that 7%. Forward looking, I have gone more conservative at 5.5. So with that, we do get an intrinsic value of $229. So we can see another, or in fact, a first signal of undervaluation. Do bear in mind, we're not looking at any of these models in isolation, and we will conclude towards the end. We then have the DCF model, the free cash flow year on year. Average growth rate, negative 1%. We have gone lower than analyst expectations at 14%. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we have an overvaluation signal. As we can see, that intrinsic value sits below the market value. Now, the intrinsic value for PepsiCo in today's episode is the average of these three models, coming to $185. Don't forget, you can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list by clicking on that pinned comment below. Margin of safety, then we start off with 10%, which we use if we believe it has a wide moat, strong financial metrics, and good forward-looking data. We can see it is around $2 shy from that, so you could argue PepsiCo has around a 10% margin of safety. In terms of Wall Street and what they forecast over the next 12 months, they have a price target slightly higher than the intrinsic value at 187 with upside of 11%. As always, let me know your thoughts in the comments below, whether or not PepsiCo is one you are adding to, whether or not you do enjoy that 7% dividend increase or you were expecting higher. Personally, it's not one I hold directly. I do hold it through ETFs. But if I was looking to add this, I would need a much larger margin of safety than 10%. There were a few red flag indicators that I did point to, notably the free cash flow payout. I would be looking here for at least a 20% margin of safety. If it came to around $150, then it would be one that I would highly consider. As always, let me know your thoughts below. If you enjoyed today's episode, smash that like button. I'll see you on the next one. And for now, take care.